What's going on, everybody? Happy Saturday. Hope everyone's enjoying their weekend so far. So, today I wanted to talk to you guys about the market crash that happened this week. I mean, as you guys already know, I kind of called it in a way, but I didn't really expect it to drop the way it did. I mean, I expected the market to drop because I know that, there were stimulus talks along the way, and then Jerome Powell, the Fed chairman, he was going to speak. So, usually, whenever he speaks, it's not good for the market, right? But I just wanted to break down, in layman, how did all this happen? Because a lot of times when people are investing, they're trading, they don't really understand like what's going on behind the scenes because there's always a lot of things going on that leads to something to happen. So we're gonna break it down today, and before we get into all of that, Ray, I want to start off by talking about credit. A lot of people think that credit and cash is the same. It is not. All right. So in America, there's approximately 50 plus trillion in credit. So credit is different than cash as it can be created out of thin air, right? So basically, let's use me and you as an example, right? I'm just gonna throw Tammy out there. Sorry, Tammy, I've been talking to you a lot, so I'm gonna use Tammy. So I know Tammy, is a trustworthy person. Always pays me back whenever I lend her money, and not only that, I know she has a house. I know she has a car, right? So that's collateral, and also I know that she has a good job. So to me, she's really trustworthy as a person that I can borrow to, right? So therefore, when Tammy asks me, Kai, can I borrow $20 and I'll get you back next month? Boom, it's done, right? Or maybe she comes to my restaurant and she eats whatever food, or let's say the bill comes out to $60 and she's saying that, you know what, I'll pay you back next time when I come, and we'll just include it all together. Boom, credit is created in thin air, just like that. All right, so there was no real money involved. It was just an agreement that she's going to pay me back, and that's what credit is. So that's the problem, because credit is basically borrowing against your future self. And basically, most of the people that are in America right now are in debt because they rely on what? Credit cards. All right? Most people don't have any cash in the bank. They just keep swiping their credit card like the money is theirs. It is not. All right? It is debt that you have to pay back. So you're borrowing against your future self. And usually what happens when too much borrowing happens, right? Interest rates are increased to discourage people from borrowing, because think about it. Um, During last year, right, all throughout last year, didn't we see more people buy houses than ever? That's because the interest rates were at its all-time lows. So why wouldn't people want to borrow money? You see, so that's basically what the Fed does, right? They increase interest rates to discourage people from borrowing, and then they decrease interest rates to encourage people to borrow. So in an economy like right now, right? It was basically like a Great Depression almost, right? So many people out of jobs, et cetera, et cetera. The government at that point wants people to borrow money, so in hopes to those people who are borrowing the money to use the money in a way that could secure their financial future, so then they don't have to rely on the government. The government basically decreases interest rates, so entrepreneurs are more encouraged to start a business, and they basically want people to like not depend on them, right? They want less people to depend on them, and they want you to be able to secure your own financial future doing whatever you need to do, be it start a business or to invest. All right, so that's why they decrease interest rates, to encourage people to borrow so they could do whatever they want to do. All right, point blank. So historically, market crashes usually has to do with a domino effect of people or companies not being able to repay their debt, like I said before, right? Sometimes people get out of hand with this debt and this credit stuff. All right, so credit is basically debt. That's how you have to look at it, right? When you're borrowing money, it's somebody else's income, but it's your debt when you're borrowing the money. And then usually what happens when people aren't able to repay debt, right? People start defaulting on mortgage payments, right? That's why in 2007, 2008, there was a real estate crash where people's homes were foreclosed and banks came and basically took their homes, and then houses, were basically at its all-time low. Like you could literally buy a house for, I don't know, like 50, $100,000 during that time, which was crazy. And then people start defaulting on loans, right? Credit card debt, and as a result, right, companies start to fold. Companies start to close down because remember they can't repay their debt. So what happens? People lose their jobs. So and when people lose their jobs, that's not a good thing because then that means that there's less people who are able to spend money. And remember, somebody's spending is somebody else's income. So if less people are able to spend, then that means less people are able to make money. And that's what usually leads to recessions and depressions. And that's what happened last year. All right, last year, I mean, yeah, like the credit card debt was definitely racked up, right? There was auto debt as well, right? People were leasing cars like with no credit, but that wasn't the main catalyst to what led to this whole financial crisis. It was the coronavirus itself, all right? And so like remember what I told you, cash and credit is different. There's about 50 plus trillion in credit, but there's approximately 6 trillion in cash. Prior to last year, there was only about 3 trillion in cash. But what happened? The feds kept printing money, right? They printed about 3 trillion dollars. So now there's, I would say, about 6 trillion in cash. And what happens when they pump more cash or when they're printing out these stimulus checks? And why do the Republicans disagree? And a lot of people are always complaining like, oh, what's taking them so long to print my money and to send me a check? It's because there's a lot of things to think about, right? Because pumping more cash increases inflation, which means that your money is worth less, which means that your buying power decreases, right? Simply put, a bag of chips when I was growing up was 25 cents. Now it's like $2 for a small ass bag. All right, so that is an example of inflation. And what happens when inflation occurs is it increases interest rates, which increases bond yields, right? In case you guys don't know what bonds are, right? Bonds are basically IOUs issued by government or corporations we as investors can buy. And it's guaranteed money they have to pay back. There's no to low risk compared to stocks. I'm going to break that down for you. So let's say Kai, right? Let's say myself, I'm issuing a bond. That's an IOU. All right. So basically, I'm saying right now that I need $20. So I need somebody to lend it to me. So Tammy decides that, okay, you know what? Kai's going to repay me back eventually. I know him. He's good for it, right? So Tammy decides to buy my IOU that I'm issuing out, right? Say I'm issuing out a piece of paper IOU. It's like a contract, right? I give you the IOU, and I'm promising you within an X amount of years or X amount of months, I am going to pay you that $20 plus interest. All right. So it's unlike stocks where you buy a stock, you don't know the stock's going to go up or down. No, 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 no. The bonds, it's an IOU. I'm promising you that I'm paying you this back in an X amount of time. It's no different than you securing a mortgage, all right, and promising the banks that you're going to pay them back X amount of principal plus the interest. It's basically that, all right. So that's why usually, bonds are no to low risk, okay, and they actually grade the bonds by like A class, B class, but we're not going to get into all of that. So usually when a government issues bonds, it's definitely a secure investment because the government is going to be able to pay you back, all right? And so it's less risky than stocks, which led to the crash this week because people saw interest rates increase. And when interest rates increase, it's more difficult for people and companies to borrow money to expand. So that's why you saw the tech sector take a shit because honestly, in order for Tesla to run or Microsoft to run or Apple to run or Amazon to run, right, all these tech companies to run, they need a lot of money, man, because the projects that they want to get into cost money. So if interest rates increase, it's harder for them to borrow money or they might borrow less money. So for them to grow, it might be a little bit more difficult. So that's why people went to bonds, all right? They saw bonds as a better financial instrument to invest in this week. But at the rate that the economy is going, it doesn't make sense for the interest rates to increase because remember, we're still pretty much in a recession. A lot of people are still out of jobs right now. Like, yeah, the job market's getting better, but at the same time, there's still a lot of people out of jobs, which means that there's less people with buying power, which means there's less people who are able to make money. And as a result, the government, the Fed, is supposed to keep the interest rates lower so people can borrow money, or it encourages more people to borrow money, so then the economy can boom again. All right. And honestly, this week coming up might be a little shaky because there might still be a battle between bonds and stocks, with the whole interest rate thing. But you know what? Historically, stocks usually outperform bonds, and March is supposed to be a strong month. So let's see what happens. All right, I hope that clears it up for you. And like I said, if you're buying big names, you're buying great names, there's really nothing for you to worry about. Um, Most of the stocks that we recommend, it's great for long holds, even if you can't swing trade it. So you should be fine. If you have any questions, please ask me, and definitely review this video because that's how this cycle works. All right. Hope this video helps.